We'll give people another 30, 60 seconds to trickle on in. Again, thank you for being here. We'll get started really soon. Thanks. All right, we'll get started. My name is Grant McCarty. I'm the co-executive director of the Bitcoin Policy Institute. I'm joined here by Natalie Smolenski, one of our expert fellows who's here today to talk to you about central bank digital currencies. Natalie currently serves as the head of business development for Highland, a software development company. She also is an anthropologist holding a PhD from the European Graduate School. Again, Natalie is here to talk to you about the implications of CBDCs, as you might have heard them, central bank digital currencies, specifically adoption by the United States. Now, a little bit about the Bitcoin Policy Institute before we get started. BPI is a think tank studying the future of money, recognizing that cryptocurrencies and other open monetary networks are here to stay. At the point where that's the case, how do we maximize the benefits for the United States, and how do we minimize the risks? One of the issues that really is the issue du jour today on Capitol Hill, but also really all around the world, is a central bank digital currency. We're hearing this on an executive level. We're hearing it from a legislative level. We're also hearing murmurs of it ripple throughout the country from a constituent level. And so at the point where this is the hot topic around cryptocurrency, we really wanted to kind of get out front of this, understand what are the implications, what should a CBDC look like, if it should exist at all, but really answering that foundational question. What is a CBDC? Why is it important? Should we have one in the United States? How does it reflect our values? Kind of go down the line. So Natalie recently published an excellent white paper on central bank digital currencies that is live on our website, btcpolicy.org. I would encourage you to read that if you're interested in digging deeper into this topic. We'll also be sending out materials after this meeting, including that white paper, as well as a one-page summary of this briefing and of Natalie's work on central bank digital currencies. So without further ado, I'm going to play a video from Representative Tom Emmer, who was very excited to join this briefing. Unfortunately, couldn't make it at this specific time, but generously recorded a video to kick this off with some opening remarks. So let me pull that up. And then after that, we'll open the floor to Natalie. Hopefully everybody can see this. I'm going to stop talking now and we're going to play this video.
Thank you to the Bitcoin Policy Institute for inviting me to provide a few remarks today at your congressional briefing on central bank digital currencies. 7 years ago, when I joined Congress, a staffer of mine gave me a book. It was called The Age of Cryptocurrency. That book discussed the promises of blockchain and crypto to disintermediate economic and social frameworks and to restore control to the individual. Today, many call this the ownership economy. But 7 years ago, I just saw this technology as a solution to the mismanagement of our monetary policy here in the United States and a restoration of individual liberty and sovereignty. As the federal government has grappled over the years with how to maintain the financial control to which it's grown accustomed, the idea of the central bank digital currency gained traction within the institutions of power here in the United States. As government-controlled, programmable money that can easily be weaponized into a surveillance tool, the very ethos of central bank digital currencies is, in fact, everything Bitcoin and crypto stands against. Therefore, as we adapt to the digital economy, the United States must guide its policies with a priority on open, permissionless, and private digital asset innovation. For this reason, I introduced legislation that will stand as a statutory prohibition on the potential surveillance tool that would kill privacy, individual autonomy, and private sector innovation. To be frank, any attempt to craft a central bank digital currency that enables the Fed to mobilize itself into a retail bank account, able to collect personal identifying information on all users and track their transactions indefinitely, does nothing but put the United States on a path akin to China's digital authoritarianism. Any digital dollar in this country must be accessible to all, able to transact on a blockchain that is transparent to all, and maintain the privacy elements of cash. Legislating, of course, takes time. Fortunately, this legislation catalyzed a conversation and awareness in Congress on the ails of central bank digital currencies. In the meantime, Congress will execute its oversight responsibility to ensure that our regulators are held accountable to the American people. Because no matter how much work this administration does to urgently advance a central bank digital currency, and make no mistake, they are moving that direction, it will never see the light of day without the authorization of Congress. The challenges behind us and the challenges ahead of us in ensuring the United States welcomes the ownership economy that crypto unlocks are significant. However, the grassroots work of the crypto community to come together and engage with Congress, regulators, and the White House have had a tremendous impact, to a degree I haven't seen since I came to Congress. I'm grateful for the opportunity to join you all today, not just for this briefing, but also in our daily fight to capitalize on the enormous opportunity for growth that Bitcoin and crypto presents. Thank you.
All right. Once again, I'd like to thank Representative Emmer and his office for being involved in this briefing. Thank you so much for those opening remarks. Thank you to everybody who has joined. I know we have a few different streams going at this point. So if you're joining, on YouTube or you're on Zoom, wherever you are, just want you to be clear about what is to come for this briefing. So first, Natalie's going to start us off with a presentation. It's likely going to take about 25 to 30 minutes, exploring all the implications of CBDCs as we discussed. And then from there, we're going to open it up to a Q&A session. Again, because there are multiple services and questions are coming from multiple different areas, please throw your questions in the chat. On whatever service you're using, feel free to send them to me privately, and then we will open it up from there. So hopefully you stay for that discussion. Without further ado, I'd like to throw it to Natalie.
Thank you so much, Grant. And thank you to Representative Tom Emmer for really being the leading voice in the US Congress against the adoption of a central bank digital currency. My name is Natalie Smolenski. I'm a fellow at the Bitcoin Policy Institute. I'm also a startup founder and business development executive, and a trained anthropologist and historian. So today I want to talk with you a little bit about the historical context for CBDCs, how we kind of got to this place as a country and as a world, and then talk about what they are. So, for those of you who aren't familiar with CBDCs, what makes them different from the ordinary digital dollars you hold in your bank account? And then, what are some of the structural drawbacks of a CBDC? And then finally, we will talk about some alternatives to CBDCs, and end with a call to, really think about not just CBDCs, but the direction that the American Republic is going, and the extent to which we are committed to differentiating ourselves in a world where the default political economy is basically a kind of authoritarian surveillance state. So without further ado, I'm going to share my screen. Grant, it looks like you need to enable me to share my screen.
Great, let me do that now.
Okay. All right, give us just a minute to get the screen share operational.
Should be good to go.
Okay, great. Okay. I just want to check with you, Grant. Can you see my screen?
Looks great.
Okay, awesome. All right. So quick overview of our agenda today. I want to start by contrasting the Chinese model of political economy, which is arguably the one gaining supremacy globally today, with the legacy American model of political economy, and talk a little bit about why this distinction is important and why it is worth preserving into the 21st century. Then I want to take a step back and actually provide some historical context for CBDCs by taking a look at the history of the internet, the history of intelligence, state-led intelligence efforts in the United States, and then introducing this concept of surveillance capitalism. Then we'll actually move to CBDCs themselves. So define a CBDC, talk about what it is, talk about some of its structural drawbacks, and then talk about its alternatives, specifically Bitcoin and stablecoins. And then finally, we can conclude and open it up for discussion. So the reason that I started the white paper with this somewhat provocative question is because, it's sometimes useful to think about political history in terms of ideal types of societies or models of political economy. And, if you were to think of sort of an ideal type of a strong state-led political economy, state-led capitalism, capitalism with socialist characteristics, a kind of neo-mercantilism, you may very well turn to China, which has been using this model very effectively, not just over the past century, but really for thousands of years. This model has, resulted in varying fortunes for the empire, but in recent years, it has worked rather well to really propel the country to a kind of prosperity and power that is unprecedented in recent history. And so, when people look at different political economic systems and are trying to make trade-off decisions about where they're going to invest, either, where they're going to live themselves, where they're going to raise their children, where they're going to, let's say, put their capital, where they're going to start a business. Often, they look at these superficial characteristics, prosperity and power, and they may not ask about the deeper structural characteristics that underpin that prosperity and power. And so the question is, what is the value of, what I call a traditional American model of political economy, which privileges a tradition of individual liberty and autonomy and minimal state intervention in economic activity? Is there value in that model? And superficially, some may look at the declining fortunes of the United States and think, well, no, there isn't. There really isn't a meaningful difference. So I might as well go to, the country that's growing the fastest, or to the country that is the wealthiest. And so, what I actually argue in the paper is that there is a causal connection between a political economy that privileges individual agency and autonomy, and that minimizes state intervention, that actually creates a value-generating flywheel, which then has ripple effects, not just regionally, but globally. And so in many ways, the prosperity of countries like China is directly attributable to an American model of political economy, which has generated so much of the value that entrepreneurs and capital in other countries can then, deploy in the ways they see fit. So even more authoritarian arrangements benefit from any one jurisdiction in the world having this tradition of liberty. And so the danger, if we step away from that in the United States and we just decide to imitate China or imitate, some other successful empire, is that we will actually, to use a biblical metaphor, sell our birthright for porridge. We will trade the very thing that has been the engine of global economic prosperity for kind of short-term imitative gain that isn't sustainable. So let's take a step back here and look at first the history of the internet. You can periodize a history of the internet many different ways. I just started in 1990 for the sake of brevity, but this was really when the World Wide Web was born. So the foundational web protocols, HTML, URLs, HTTP, SMTP. This was the era that the original, ARPANET really started becoming accessible to the wider world. And the 90s were kind of the Web 1.0 era, characterized by the introduction of the first web browsers, static web pages, email, real-time news. It was also a very peer-to-peer web, because at that stage, there weren't very many people using the internet, and the ones who were using it tended to be more technically savvy. So they knew how to use these protocols in a way that was peer-to-peer. As the web began to expand in adoption, however, the challenge became usability. It became, how do we make this technology for the transfer of information more democratically accessible, and ultimately, more accessible to a growing consumer base that wanted to transact online. And so this was really where, the introduction of the secure information transfer protocols like SSL, HTTPS, that is really what opened up the world for e-commerce and Web 2.0, which is the dynamic social and mobile web that most of us are familiar with. User-generated content is king. Websites are responsive, they are dynamic. We saw the birth of, FANG, the big internet platforms. And this really made the web accessible to people who were not technical. And then with the introduction of the iPhone, we saw the smartphone revolution come about. And so this really, it's difficult to overstate how much this transformed not just the global economy, but like human life. Information wants to be free is kind of a well-known phrase. And the internet is the invention that was built to facilitate the free transfer of information. However, there was a bit of a fly in this ointment because with the added convenience provided by these infrastructure platforms, the web became more and more centralized. So a smaller number of companies started controlling, mediating, gatekeeping access to information, both information about the world and information about oneself. So, if you want to move your personal data from Facebook to Google to Twitter, good luck. Like these platforms own your data, and they're not going to make it easy for you to port that anywhere else. And so we have a world, an internet characterized by vendor walled gardens and lock-in, which, is part of what creates the stickiness of these services, but it also really disempowers the user. And so right around, when the Web 2.0 commercial revolution was at its peak, someone named Satoshi Nakamoto introduced the Bitcoin white paper. They introduced, very humbly, a form of peer-to-peer digital cash, which, only really a few enthusiasts took note of at the time. But since 2009, since the first transaction started being recorded on chain, the adoption of Bitcoin has really exploded in parallel to and even faster than the internet itself. And so this has kind of moved us into potentially a new stage. And there's been so much, marketing hype around it that, whether you want to call this Web 3.0 or Web 5 or whatever, what matters is that there is now a concerted push toward a more decentralized web experience. So using trustless and permissionless peer-to-peer protocols, people are now building new infrastructures for transacting via the web. So what this means is that there's a counter movement now to take power back from some of these centralized platforms and pull it back in the direction of the user. There's still a ways to go before many of these services become commercially viable. So we're still very much in the early days of this. Nevertheless, that doesn't mean it's not real. And those who dismissed the internet in the 1990s are, finding their kind of next generation cousins in those who dismiss Bitcoin and the movement for decentralization online. So I want to shift gears a bit now and talk about, the growth of US intelligence agencies. This may seem unrelated, but in reality, I mean, as we entered into an information economy with the birth of the internet and the software industry as a main driver of GDP, simultaneously, intelligence became the hottest commodity for governments. And so you can see here really like an exponential growth in the number of intelligence agencies founded in the United States over the past few centuries. And we're just at the beginning, of the 21st century. So who knows what other intelligence agencies are going to be founded. This is just federal intelligence agencies. This does not include police. This does not include, Department of Justice and various regulatory agencies that, function in a law enforcement manner. This does not include the military as such and all the associated defense spending. So just these 18 intelligence agencies alone cost the US taxpayer over $86 billion a year. That's as of 2020, so it's almost certainly higher now. And the reason I'm pointing this out is because, the internet has greatly enabled and facilitated the collection of information about individual activity. And that is percolating through all of these intelligence agencies, most of which, share that with other intelligence agencies, whether domestic or foreign. And so we now have a constantly circulating stream of data about what US citizens, residents, and others are up to, and virtually no visibility into how that is being used. This connects to the financial world through the explosion of anti-money laundering regulations and policies that have arisen both domestically and internationally to combat money laundering. This really took off after 9/11. The Patriot Act in the United States created sweeping new surveillance powers for the government and for banks who are responsible for a lot of this frontline financial reporting. The problem is that, like with most policing, it's easiest to go after the people who are the least dangerous, and so that means ordinary people. It means the poor, the middle class, people who don't have networks of individuals, lawyers, private security forces, and candidly bought off officials to protect them. And so for this reason, the broad effectiveness of AML regimes has been pretty lacking at best. So a social scientist named Ronald Pohl did a study in 2018 that, was really pretty damning as far as AML policy goes. The interventions have had less than a 0.1% impact on criminal finances. Compliance costs exceed recovered criminal funds more than 100 times over, and banks, taxpayers, and ordinary citizens are penalized more than criminal enterprises. And so, this is not to suggest that, there should not be a rule of law, only that the way that law is enforced typically it provides all sorts of outs for people who can afford them. And this is seen as well in IRS audits, which, ProPublica did a study in 2019 about the likelihood of these audits by county, and it just strikingly correlates with poverty. So, the recent push by the Biden administration to, hire 87,000 additional IRS officers is, to be charitable, motivated by desire to go after wealthier tax evaders. The problem is that in practice, it's likely to tighten the noose around people who are already over-policed and over-surveilled. So along these lines, last year, the IRS introduced a new rule that basically if you make over $600, on your side hustle using these marketplaces like Etsy or cash or payment systems like Venmo, you now have to report that to the IRS. And so again, is it really the people making, a few $1,000s a year in like spending money that are the most in need of being policed? Is that really, where the unrecuperated revenue is that the federal government is seeking? Or is this a way to clamp down again on the least privileged because attempts to enforce tax payments at the top of the pyramid are so unsuccessful? And so this correlates with a growing demand for public surveillance systems as well. It's not just financial. Cameras, video monitoring systems, platforms, software platforms that gather data in an interoperable manner so that it can be more easily shared, like state, municipal, and federal governments are investing billions of dollars in these systems as we speak. This is something that is often, it's done without public oversight or without really any public feedback or concern. However, when it's discovered retroactively, the justification is generally, crime prevention. And this is a tricky subject because, the question is, in a society with perfect surveillance, where everything is visible to the state, is that a society worth living in? And I think that's a question that very few in public service are asking. So, all in all, what this points to is that we are living in an age of surveillance capitalism, where both, for-profit companies and the government are incentivized to collect as much information on as many people and store it for as long as possible. This surveillance capitalism is a term coined by a scholar named Shoshana Zuboff at Harvard Business School. She published a book about it in 2019, and it's a pretty apt term because it sort of helps clarify why, despite the backlash against specific actors in this space, periodic outrage against Google or Amazon or Facebook or whatever, for some reason this system of surveillance capitalism continues to intensify. Well, it's because both corporations and the state are in fact incentivized to intensify it. And so what can break this cycle? The only thing that can break this cycle is an active and activated civil society that simply starts saying, no, no more. You don't get this information. This is not characteristic of the values that we wish to inhabit as a people. So how do CBDCs play into this? Well, CBDCs are an extension of the logic of surveillance capitalism to the last remaining sphere of autonomous economic transacting, physical cash. So the problem with physical cash is obviously that you can transact with it without reporting anything to anyone. And CBDCs are in actual fact cash. So they are a fiat currency that is a direct liability of a central bank. That makes them different from the digital bank balances we all have, in our online checking accounts or savings accounts. That is actually commercial money that is issued to us by commercial banks, by private banks. A CBDC is what economists would call M0 money supply. In other words, the money that's directly issued by the government. And CBDCs are programmable. This enables central banks to surveil all financial transactions. They can flag, block, or reverse any transaction at any time. They can determine how much cash anyone can hold or use. I mean, they could decide you can't have more than $1,500 worth of CBDCs in your account, and you can only spend, 5% of that a day or whatever. There's no technical obstacle to that level of control. They could also determine, what you can and can't buy with that. So in effect, cash, which was money, becomes a kind of token or a kind of script, like at the company store, where you get a certain number of tickets that you can use for food or clothing or these services, and you can only buy them here, you can't spend them over there. I mean, all of this now becomes fully programmable, as well as monetary policy. So if a central bank wanted to confiscate some private wealth, which is very plausible since every central bank is significantly underwater, they could implement negative interest rates directly on your CBDC account balance. So, and they can set whatever interval they want. I mean, it could be a negative 2% cut a week or a month or a year. I mean, whatever they want, to incentivize you to spend that money quickly and to disincentivize saving. And then, of course, they can just directly confiscate the cash. I mean, there's nothing preventing them technically from doing that once a CBDC is implemented. Finally, tax collection on every cash transaction. So, you want to sell some things at a yard sale. Well, now like every little knickknack you sell is going to be taxed. Like you want to give your kid an allowance. Okay, now that gets taxed. You need to pay your friend back $20, from dinner last night. Okay, that's taxed. Like this is probably something they would deny today, but it is fully possible with the implementation of a CBDC. And so, all of this is gearing up for the eventual elimination of physical cash. The Fed denies this, the European Central Bank denies this, but when we think into the future and we try to make predictions, it's really important to look at what the incentives of actors are, because over time, organizations, entities, people will largely act in line with their material incentives. And the reality right now is that governments are deeply, deeply in debt. Some have already collapsed, and others are on the precipice of collapse, of insolvency. Global debt to GDP ratio was over 350% by the end of 2021. That was the end of last year. And fully a third of that had occurred only in the past few years. So we're in a sovereign debt spiral right now. and governments need cash. Economists call this the doom loop, because the more indebted a government is, the less creditworthy it is. So the more expensive it becomes for them to borrow money. But generally, the more indebted a government is, the more it has to borrow to remain solvent, like we just saw with the Central Bank of the United Kingdom. So this is a vicious spiral, and there are very few ways out of it that don't end, terribly poorly. So, this story kind of flew under the radar, but in June, the European Central Bank basically suggested to indebted Eurozone states that they just, park their cash at the ECB in order to give them, more favorable lending rates. So this is, kind of small step in that direction, but in effect, they're saying, give us your collateral. And it's not too hard to imagine that cash confiscation will begin in earnest, not just from other central banks, but from private people. So who's actually looking at CBDCs? Everyone. I mean, like virtually every country in the world is looking at developing these. They're in various stages of developing them, but as of May 2022, it was over 100 countries representing over 95% of global GDP. So that is not insignificant. And in fact, that is part of what American advocates for a CBDC have used as a reason why the US needs to do it. We have to maintain our global competitiveness. We have to maintain our innovative standing. We can't let these other countries do this and leave us behind. The question is just innovation for whom? To what end are you innovating? And so, Representative Jim Himes from Connecticut has been one of the most outspoken advocates for a CBDC, largely, I think, because he believes that it is the most trustworthy form of cryptocurrency because it is issued directly by a government. The problem is that he's making this claim, as faith in central banks is collapsing worldwide. So I think there are some, perhaps unexamined assumptions here that need to be discussed openly. Perhaps most concerning this year, there was a bill called the eCash Act introduced by Representative Stephen Lynch from Massachusetts that would direct the Treasury, not the US Fed, to develop a central bank digital currency. And I don't know if anyone saw this coming. The legislation that Representative Emmer and Senator Ted Cruz introduced in the House and the Senate, respectively, this year would prevent the Fed from developing a CBDC and launching retail bank accounts. But it says nothing about the Treasury. And so this is kind of, to me, an indication of how, in effect, the Fed has been fully politicized, where it's hard to, it's like this hot potato, like who is Congress going to direct to act, the Fed or the Treasury? But both of them seem, captive to the overriding political concerns of whatever administration happens to be in power. And so this is the problem. It's, for Lynch and for the other co-sponsors of this legislation, I think, most charitably, to steelman their argument, they see retail bank accounts with the federal government as something that would enable direct cash payments by the federal government to US citizens. So stimulus checks, universal basic income, if you have an account with the Treasury or the Fed, they can just deposit that money immediately, as opposed to mailing you a check and you having to wait for it and it potentially getting lost or intercepted or whatever. So like that charitable assumption can be attributed to some of these folks. The problem with it is that, once you create a system for that type of instantaneous giving, you also create a system that enables the instantaneous taking away. And so it creates a kind of direct relationship, which is both unprecedented in banking history and very problematic from a human rights standpoint. So let's talk a little bit about some structural problems with CBDCs. We've talked about some of the human rights implications of this, but there are also, some just market implications as well. One is the contraction of the commercial banking system. So, if the Fed or the Treasury started offering retail accounts, then that would cannibalize the business of the private banking sector. So basically, if I have, cash in my CBDC account, that's probably not cash I'm going to have in my checking account at a private bank. And banks actually rely on those deposits in order to conduct their lending operations. And so, some estimates have said that a retail CBDC implementation could contract the commercial banking system by as much as 20 or 30%, which would be really significant. So for that reason, a lot of private banks have opposed the rollout of CBDCs. There's also been a kind of rise in this wholesale CBDC model where the Fed or the Treasury would issue the CBDC to a bank, and then the bank would issue it or maintain the accounts for individuals. The problem with that, though, is that you're still getting rid of physical cash and providing full visibility into every transaction, because as you guys probably know, the digital banking system is fully surveilled. I mean, like every transaction you make online is currently observed and recorded in ledgers that can be shared at any time. So it's tricky. The other thing the other structural problem with CBDCs is that there would have to be, in order to roll this out in a way that didn't cannibalize the commercial banking system, there would have to be tight caps on the amount of CBDCs that anybody could have at any given time. In other words, in order to not cut into your bank deposits too much, the government would likely set limits on how much you can have in your CBDC account. So I believe it's the Bahamas, they rolled out a CBDC and their cap is something like $1,500. And it would have to be similar in the US. Analysts have estimated anywhere from $1,500 to $2,500. So that's not a lot of money, first of all. And second of all, if you are implementing negative interest rates on that amount of money, then you're basically just chipping away at the tiny savings that a lot of people have. And for many Americans, most Americans live paycheck to paycheck and have less than $1,000 in their checking account at any given time anyway. And so that level of central bank intervention in terms of how much they could potentially save, and then the monetary policy that could confiscate that cash over time feels just on its face immoral. Another issue is that governments are not actually set up to be technology service providers. So a digital CBDC would, of course, have to be a software solution that is implemented and maintained with a very high level security over a very long period of time. Governments, may have a lot of very skilled people, but they're not organized in a way that enables those people to prioritize the delivery and maintenance of quality software. That's just not the job of the government. Even the technology-oriented agencies, they're not software companies. And so they likely, the central banks will have to rely on the private sector to provide the technology infrastructure for CBDCs. And that in effect, has privatized the mints. So that's another question is, do we really want, for example, Amazon minting digital cash on behalf of the US government? It further centralizes power in the hands of these software platform providers that are already relatively unaccountable. And that brings us to the question of security risk. Obviously, the digital realm is a primary theater of war. A lot of conflict is occurring now in the online realm rather than kinetically. And CBDC ledgers would just be like these giant centralized honeypots of personal data that record every transaction that is also identity verified. It's been long known that governments share data with one another. Intelligence agencies, security agencies share data all the time. But these systems are also frequently and more frequently the target of hacks. So in 2020, I talk about this in the paper, FinCEN database was hacked, and it exposed the identities not only of people who were reported for potential financial crimes, but also the specific banks and the specific compliance officers who reported those people. So, we don't know how many people were, killed or retaliated against in light of this, but that's just one example of what happens when a government database is hacked. Another recent example was the Shanghai police database that, was just sitting on a unencrypted server and had 1 billion people's PII on it. And that's just circulating on, the open markets now. So, big enough databases on a long enough timeline tend to get hacked. And if you create a giant ledger of every financial transaction happening with cash anywhere in the world, that is going to be a prime target. And then finally, this whole question of centralized blockchains. Honestly, the push to create central bank digital currencies is a response to Bitcoin. When Bitcoin was introduced, at first, people kind of ignored it, laughed at it. Now we're in the stage where governments do feel a certain amount of pressure, if not threat, from a stateless digital currency. And so they've kind of gotten this idea that, first of all, that they need to compete with Bitcoin, even though the value proposition is completely different. But second, that the best way to do this is to create their own blockchains. This is not only unnecessary, but it's sort of an oxymoron, because if you create a centralized blockchain, it's not actually very different from a centralized database, which already exists. Every payment provider in existence today, Visa, MasterCard, others, these are all centralized databases that record transactions. So the question again is why is there so much hype around this technology? It seems self-defeating. So what are the alternatives here? The thesis of the white paper is that CBDCs don't solve any problem for anyone, other than potentially for indebted states to confiscate private wealth. Rather, every monetary or financial use case can be covered by existing payment methods. And those are digital dollars, physical cash, Bitcoin, and stablecoins. So Bitcoin, many of you know what Bitcoin is, but for those who don't, this is a peer-to-peer digital cash that was built by cryptographers and computer scientists who recognized that the internet would inevitably give rise to surveillance capitalism, and that if they didn't build the technology primitives to carve out a sphere of privacy and autonomy, that it would be completely overridden. Bitcoin is designed very much with a privacy ethos. That is not to say that it is perfectly private. In fact, it is a publicly auditable settlement ledger. And so until privacy tech advances in Bitcoin, it's still possible to track transactions and track down people who are using the ledger. That, though, is something that there are a number of privacy proposals to preclude in the future. But ultimately, its value proposition serves from being a decentralized Fedwire, which means it's basically a publicly auditable settlement ledger that is global, that is censorship resistant, that is a-jurisdictional. And so it functions as a kind of global monetary DMZ, or demilitarized zone. And this is very important in an era where money has become fully politicized, as we've seen, in the Russia-Ukraine conflict. Even sovereign states are not immune from having their assets confiscated and being cut off from a global payment network like SWIFT. So what this means is that increasingly the value proposition of Bitcoin as enemy money, where you assume an adversarial network, you assume the people who are transacting with you on the other side of the transaction are not to be trusted, that is becoming the default. So we're moving from a trust-based model of financial transacting to a trustless model of financial transacting. That doesn't mean, though, that fiat currencies are simply going away. Rather, what is most likely to occur is that Bitcoin will survive in a trade pair with many different fiat currencies around the world, and just be a kind of neutral form of money that you can translate or not translate into political money when and where you need to. I wanted to share this adoption curve because it's, a lot of the people today who dismiss Bitcoin, I think maybe look at the number of users and they're like, oh, well, that's not that much. But let's remember that the number of internet users in 1997 was, on par to where Bitcoin was a year and a half ago. So this is the most recent data that I could find, but the adoption of Bitcoin has been happening at twice the rate of the adoption of the internet. And so we'll very quickly reach a tipping point where it won't be possible to ignore this technology. It also won't be possible to meaningfully censor or restrict it. And so the question for sovereign states is, who is going to have the courage and the vision to embrace this technology, to recognize that it serves a purpose, both for your people and for people around the world. And what then is the value proposition of the state? That becomes a question you actually have to answer, rather than simply assuming an answer, which has been kind of the default mode. So stablecoins, I've mentioned these a number of times. A stablecoin is just a cryptographic token which circulates on a public blockchain. So it is, like Bitcoin in that way, but it's different in that it aims to track the return of sovereign currencies. So they're generally stablecoins, are pegged to some fiat currency or another, and they're basically used to transact with that currency for use cases or in jurisdictions where it may be hard to get your hands on digital dollars or physical dollars, for example. And I say dollars because over 99% of stablecoins are denominated in USD. I mean, that's by far the biggest use case. They're similar in this way to euro dollars because they're privately issued money, and they don't have to be backed one-to-one, with US fiat currency. So some have proposed, to call stablecoins crypto dollars, much like the euro dollar system. It is the thesis of the white paper, though, that for stablecoins to be widely trusted and accepted, they should be backed either one-to-one with USD or treasuries, or with other hard assets like gold or Bitcoin. We saw, with some of the algorithmic stable coins earlier this year, that that is not a reliable model for maintaining the value of stable coins. They have to be collateralized one-to-one. And the benefit is for those who are invested in this outcome, that if stable coins are backed one-to-one with US dollars or treasuries, then they serve as a new source of global demand for US dollars and prop up its status as a global reserve currency. So it's actually in the strategic interest of the United States to back stablecoins, but we will see if that point of view prevails. I thought it would be worth just quoting here Randall Quarles, who was the vice chair for supervision of the U.S. Federal Reserve, who basically pushed back against people criticizing stablecoins for not being direct liabilities of the Fed by saying, banks and private firms create money every day. Privately created money is money for all intents and purposes. And so that objection doesn't particularly hold weight. The question is, what type of money are you wanting to incentivize the creation of in a certain way? And so, this is really the takeaway. Who will we be as a country? We've sort of been, I think, derelict in having this conversation. And so, we've just been doing what's easiest, which is slowly kind of drifting toward the increase in surveillance and jettisoning of individual autonomy that mirrors countries like China. We often cloak this in noble language around financial inclusion or justice, but the reality is that those who are most likely to be targeted by a punitive surveillance state are the poor, the marginalized, and those with little power to advocate for themselves. And so the question is, are we going to have the courage to differentiate ourselves as a nation, to stand for something truly, unique, liberty and justice for all? And if we forget this mission, then we also will forgo our republic, as the founding fathers warned. So with that, I will wrap up and open it up for questions.
Thank you so much, Natalie. We're coming up on the hour, but I do want to do a couple questions. I know some people have had to drop off. If you do have to leave, no worries. Please feel free to send your questions, in an email. Feel free to drop them in the chat and we can get them now. But it looks like there are two questions that I've highlighted that I think we can get to now. And then if any more pop up, we can decide from there. But I want to start with this first one because I think it's probably a question a lot of people have. So you talk about potential risks of CBDCs. The question says, you talk about a lot of things that could happen if we adopt a CBDC, but the White House has said that CBDCs will need to preserve human rights and financial inclusion. Isn't it speculative to believe the government will abuse the CBDC system in the ways that you mentioned?
It is not, because the technical implementations of a CBDC would all enable those very abuses. And so, it's kind of like making a promise that, you're not going to do something like as you do it. The intentions may be great, but a lot of the people advocating for CBDCs are, they're either not technical or they are technical and just very comfortable with, the kind of full surveillance database creation that has been par for the course. And so that's really the question. The people claiming that this power won't be abused, are you at all perturbed by the abuse of power that is already occurring by the surveillance state? Because if not, then I would suggest that perhaps our values are simply different. And then we need to have that conversation.
Great answer. We've got another one here. It says, you claim Bitcoin is a viable alternative, but if no one controls Bitcoin, then how can the United States use it to achieve its goals? What about sanctions, et cetera?
Yeah, I mean, the imposition of sanctions happens in very different ways, right? So we most recently have seen an example of sanctions imposition that involved cutting off a sovereign or sovereign affiliated individuals from the global financial system. However, that is not the only way that sanctions can occur. And so the question is, if you're committed to sanctions as a tool of foreign policy, which, there also needs to be a debate about the effectiveness of sanctions, whether they actually, achieve the aims that we say they will achieve. But if you grant that they are effective, then the question is, to what end and what means do you have at your disposal? So, the ability of the US government to sanction its enemies has not been affected whatsoever by the existence, for example, of gold, which is a hard asset that, virtually every sovereign owns, some amount of, although the US has by far the largest world supply. That is an unaligned form of, used to be commodity money. Now it's a hard commodity that can be monetized. We have no problem imposing sanctions as gold continues to exist. And so what I suspect Bitcoin will do is it will provide a kind of neutral language of value that nevertheless there will be a land grab for. And so there is a finite amount of Bitcoin in the world. It is in the strategic interest of countries to stockpile it. And we may see the types of contestation around Bitcoin that we saw around gold in the early 20th century and mid 20th century.
Great. I have one more question, and I think it actually aligns with the comment that you made earlier, which is, we might have different values. And one value that I think is implicit in your presentation is the value of privacy. And you talk a lot about financial privacy. And I know this is something that has come up through our work as the Bitcoin Policy Institute time and time again. And I just thought it might be helpful, and I guess I'll frame this as a question for you to explain why is privacy as a value important? And why do you think that's something worth preserving as we move into the digital age, where there's kind of unlimited potential that can be achieved if you're willing to potentially sacrifice some of these values that we're discussing?
Yeah, that's a great question. And the answer I would say is that privacy is a non-negotiable characteristic of having an autonomous self. In other words, if you have no boundary between yourself and the world, it becomes virtually impossible to meaningfully grow and develop, to cultivate new ideas, to try things out, to engage in the very economy of innovation that we have been so proud of in the United States. And Edward Snowden, who I quote in the paper, makes this point. He says, privacy isn't about something to hide. It's about something to protect. And, the people who who say that, if you have nothing to hide, then you shouldn't be concerned about privacy, are basically saying that, you shouldn't be concerned about freedom of speech because you have nothing to say. And so that's the question. Do you have something to say? Is there a person that you want to become in the world? Is there a kind of experimentation, growth, and development that you are invested in for yourself and for the people you love? Well, then you got to have privacy.
Love it. Well, look, we're a few minutes past the hour, past 1 Eastern. I know we said we would cut this off in about an hour. I'd like to invite anybody who is on this call, anybody who's listening, if you're connected to a congressional office, if you're connected to really, anyone doing work in and around the government in Washington, D.C., I'd invite you to set up a meeting with us. Natalie, I don't want to speak for you, but I'm sure you'd love to,
Yeah, of course.
with various offices, discuss central bank digital currencies. Again, all of this is taking place in real time. When we talk about CBDCs, it is this like this gigantic idea that isn't just, it's not a monolith, right? There are all sorts of CBDCs. The Fed is actively trying to figure this out. The White House is actively trying to figure what this should look like, or if it should exist at all. And so if you're interested in continuing this conversation, if you have any more targeted questions, please let us know. And Natalie, I will leave the floor to you. Any closing remarks?
Yeah, I think we're at an inflection point as a country, as I've said, and the decisions we make over the next few years, including technical decisions about what types of software and architectures we use to conduct government operations, will determine who we become as a country. And so it's not negotiable to understand these issues. And I'm more than happy to talk with anybody in more detail who wants to learn more about them.
Amazing. Well, thank you so much, Natalie. Thank you for this wonderful presentation. And thank you to everybody who joined. Looking forward to doing something like this again and seeing you all on the Hill. So thank you. Have a great day.